The whole options industry owes RoaringKitty a big thank you, because what that whole GameStop AMC scenario did, that really pushed investors to push their advisors to become more aware of and engaged with the options market than they had ever been.
So from a long volatility perspective, some people argue that put buying is generally overpriced and therefore not worth it over the long term.
Remember, the person from whom you're buying those tail risk options is also taking on that tail risk themselves. So why would I price that in an aggressive fashion? I want to be, very generous in that pricing because I'm taking on a lot of risk. And there have been enough episodes in finance to prove out that taking on that risk is not profitable. And there have been enough trading firms to get wiped out by that tail risk event to know that that's not profitable.
Hello, everyone. Welcome back to the Alpha Architect YouTube channel. Today, we have the pleasure to talk to Joe DeSipio, CFA FRM, who is the managing member and chief market strategist at Arin Risk Advisors. Arin Risk Advisors is a fee-only option strategies advisory firm providing asset risk and volatility management services to asset managers and advisors. How you doing, Joe?
I'm doing well. How about yourself?
I'm doing good, man. I wanted to have you here just to give us a peek into the world of options. You're the expert. But first, I wanted to hear about Arin Risk Advisors. So talk to us about the firm. How did the firm come about, and what is the mission you are seeking to accomplish?
So for Arin Risk Advisors, we've been around since 2009. And what the rationale behind starting Arin Risk Advisors was from the financial crisis of 2008 and so forth, people started paying a lot more attention to protecting their assets. That whole stay blind and let it grow kind of idea kind of faded into the abyss a little bit. Of course, that came roaring back in subsequent years. But at that point in time, people were more concerned about risk and how to deal with it. A big tailwind for us was the fact that volatility levels were extremely elevated coming out of the financial crisis as well, which offered us a lot of trading opportunities. So we kind of had two favorable option forces helping us. One was elevated volatility, and the other thing was market demand. At that point, we figured, you know what, we may as well start Arin Risk Advisors. And unbeknownst to me, but simultaneously, what was happening was any floor market maker or specialist that was on the floor, and I'm right outside of Philadelphia, so we're fortunate enough to have the Philadelphia Stock Exchange right near me. I'm also fortunate enough to have one of the largest market making firms right down the street from me as well. And what happened was those option markets started getting a lot more electronic, a lot more computerized, and there was a lot of human talent that was becoming idle or less utilized than they would like to be otherwise. So I was able to hook up with some people from that firm and take their market making and trading specialist expertise, couple that with the market demand and the market structure at that time, and be able to start a firm that was offering on a fiduciary basis option trading strategies for registered investment advisors, family offices, and some individuals.
That's great. And you started off doing that. Has the firm evolved over the past 15 years or so?
Primarily, we started off just doing SMA accounts and opportunistic trading. Again, the opportunistic trading kind of went out the window as volatility kind of fell from the sky. So opportunistic trading became a little bit more client demand driven, which was folks wanting to utilize the options market for improved lending rates. So there's a couple of trades within the options market that you can utilize in order to extract the interest rate from the options market, use that instead of holding cash balances or instead of taking out a margin loan. We utilize the option market for that. So that became one of our bigger lines of business after the volatility vacuum came upon us. But we don't do too much in the way of directional trading. I know you mentioned that. Directional trading is just very, very difficult. I know you can read off of a gum wrapper, you buy an option for 5 cents, it goes to $20, but that's few and far between for how many times you lose the 5 cents, get frustrated, and stop doing it. So that's really not our bailiwick. We're more involved in the portfolio protection and utilizing the options market for synthetic means to address what a normal kind of quote unquote normal portfolio manager would be doing. And we believe, if those option dynamics line up right, you get improved outcome and lower amounts of risk.
So let's talk about you, Joe. How did you land in the world of options out of all things? So, maybe you started off in finance, you like money, you like investing, but how did you pick this niche topic that is options?
I think I always resort back to the fact that I'm a genetic defect. My father was a precious metals trader, so the idea of using futures and things like that was kind of just household language for me. So switching between the futures market and the options market became really just everyday terms for me. And I was kind of surprised whenever I graduated from school that people weren't utilizing futures and options as much as I had heard about futures and options being utilized in the marketplace. So I just gravitated towards that area of the business where there weren't that many players. Especially on the kind of the buy side. Of course, there was the market making side and the sell side that were utilizing options. But as a fiduciary serving private clients and family offices and things along those lines, there really was not that many people out there doing that kind of work. So I just kind of gravitated towards there because I thought that was the place where I could be able to help the most people.
That's interesting. So when did that shift happen? Do you say like high school, college, where you decided, hey, options is the thing that I'm going to go for?
It was pretty much, I remember doing investment challenges in college, and I was utilizing option strategies there. And I think I was the only contestant doing options and futures in that. So I've always, like I said, I blame genetics.
That's fun. That's pretty unique. I've never really heard of that. I think people come into the world of options later on, but it makes sense with your father trading, being a trader. So, for beginners who don't know too much about options, it may seem confusing at first, even for indexers. When they hear the word options, they probably associate it with Wall Street bets, just gambling where you just pick a stock and hope it goes to the moon. And people would just be buying an option contract the way one buys a lottery ticket. But in your view, how does one use options properly?
Properly, it depends on your client situation. So there's really no one right answer. Sometimes it is okay to buy those lottery tickets. Okay. Again, if you have someone with a risk appetite that's looking to make a bet on something, then there's no faster, better, easier way than doing it in the options market. Now, you have to buy the bet at the right price, and that's where we like to think we're helpful in helping guide investors to paying what the right price is. Again, that market making mentality is central in our firm to figuring out, okay, how much would I pay for this thing versus where the market is pricing it. So to that extent, we like to be helpful in that regard. But again, it's the typical wealth management situations. I have a concentrated stock position. I don't know what to do. My client should be more diversified. I have a client that's nervous about the market, but they don't want to sell because of taxes. I have a client that's frustrated with the bond market because the bond market has lost money over the preceding 3 years or whatever it was. Again, all of those client situations, it's just nice to have some level of competition between the pie chart solution and utilizing the option-based solution. One thing, however, that does come up all the time, and one of our favorite and biggest advisory clients has coined the term explanation risk, and that is the largest risk in the options market, I would say, just because people think they know what they're buying, no matter how many times you explain what they're buying. When that negative event occurs, they have no recollection of what happened or why that happened. And again, it's just the explanation risk of getting a client from point A to point B that's the most challenging. But in terms of finding a solution, I think, again, it's not always going to be the right answer. And I think that's the important thing, that a lot of option people think you just throw options against the wall and it's going to stick. Sometimes, no, it's not. Sometimes the option prices aren't good, and that's okay. You're allowed to use the cash market. You really are. It's there for a reason, so use it when you can.
So it sounds like a lot of what you do is overlaying options to risk manage or to structure certain payoffs. Is that right?
For some accounts, yes. And for other accounts, as I pointed out before, that lending and borrowing business is still pretty big for us. would say, again, helping people manage the risk that they have embedded in their portfolio from concentrated holdings is another big avenue of client demand for us too.
All right, let's step it back and look at an average investor. How do you think about smart portfolio construction in your view? How does one go about building wealth? And can options play a part in a diversified portfolio? Obviously, when I say building wealth, within parameters of risk and risk tolerance and all that good stuff.
Right. So I think, one of the terms that I don't like is modern portfolio theory, especially, or any statistically driven means of designating asset class allocation or stock selection, is because one of the key drivers of that determination is either the variance or the standard deviation of the expected returns in those portfolios. What that means in fancy terms is somebody knows what the distribution of those returns is going to be in the future, and nobody does. And we don't think that the future returns are going to be normally distributed. And if they're not normally distributed, then you need a higher order function than standard deviation or variance in order to help explain or capture the risk that your client or your portfolio is taking. So the way you can address that ancillary risk or uncovered risk by the statistical measure of simplicity, the normal distribution, is to overlay options into that portfolio. So you can utilize options from a novice investor to a professional investor and pretty much everywhere in between, whether you're looking for growth, for income, for value, for momentum, whatever the particular strategy you have. Again, the options market is there kind of as a comparative tool. You can find out what is the options market telling me about the expected future return for this portfolio versus just my statistical back test.
If I were to classify you, let's say, hey, we have like the Jack Bogle part of town where it's indexing, like just keep it simple, versus, I don't know, I want to go to like Nassim Taleb where he's just like, hey, just, mostly short the market or keep a big exposure to, tell hedging. Where would you find yourself in that scale?
Combining all the above. Again, there's no set right answer. There are sometimes, yes, like I pointed out before, the cash market can be your friend. So yes, go do the low cost, simple thing, which is to go buy the index, full stop. Other times, the world may not be as sane and as rational as we like it to be. So yeah, then you have to add some optionality to your portfolio, and that's okay too. Sometimes that optionality is very expensive. That's not okay. So sometimes you have to hold your nose and do it, and other times you don't have to. Again, it's just more tactical in that regard, but just driven by the option pricing and the expected payoff, as opposed to thinking there's some trend following mechanism that you can employ in order to help hedge or get engaged with volatility. I think that's a fruitless exercise.
But interesting you mentioned trend following, because that's where I want to go next. I want to get a little bit nerdier here. So from a long volatility perspective, some people argue that put buying is generally overpriced and therefore not worth it over the long term. And therefore one needs to seek for alternative forms of long vol assets, such as trend following. You could do like a quality minus junk type of strategy, anti-beta. There's different things you could do, but hey, just don't just buy put options and roll them over. What's your response to this assertion?
Generally, put options are very expensive. It's just like, is buying your auto insurance expensive? Yes, until you need it. And then all of a sudden it becomes the most rational purchase you can make. It just, again, it gets back to that problem of trying to think you know more than the market. And that's hard. Because again, the market, remember, the person from whom you're buying those tail risk options is also taking on that tail risk themselves. So why would I price that in an aggressive fashion? I want to be, very generous in that pricing because I'm taking on a lot of risk. And there have been enough episodes in finance to prove out that taking on that risk is not profitable. And there have been enough trading firms to get wiped out by that tail risk event to know that that's not profitable. So again, there's ebbs and flows in how richly priced those put options are. But I think if you use the put options just as a If you view the put options just as a drag on your portfolio and accept that, why would you do that? Because you better be taking risks somewhere else that's compensating you for taking that drag on your portfolio. So, for example, if my expected market return for equities was 10% and my expected market return for bonds was 5%, why would I be in a 60-40 portfolio as opposed to a 100% equity portfolio if I can go buy the optionality for, I don't know, less than 5%? Maybe I can buy it for 4%. Now my expected return on my portfolio is 6 versus 5. So that would seem to be a better deal for me in terms of how am I going to hedge my portfolio. And as 2022 taught us, even if the market goes down 20%, that doesn't necessarily mean bonds are going to help you. So they may help you or may not, but put options, because they're based upon math, that generally is going to help you depending upon which option series or strike that you're purchasing during the course of the year.
All right, so let's jump into the next question.
Sure.
One thing one could potentially do to manage the cost of tail hedging, instead of buying puts and constantly holding them, so this would be the static sort of approach, we could do a dynamic hedge where, based on technical indicators or fundamental data, you are either buying or not buying. So how do you view the use of these two strategies? Which do you prefer, or which is appropriate for what type of scenario?
Well, if I'm looking at trying to hedge a portfolio against a smaller down move, maybe like a 5 or a 10% move where the client's more nervous or anxious, or their wealth plan requires them to preserve assets a bit more, then maybe that idea of adding some kind of trend following indicator in there would be helpful. But if you're buying those crash protection puts, nobody calls you and says, hey, the market's going to crash. Usually that's kind of coming out of nowhere. So in that instance, I think you have to hold the crash puts no matter what. You just got to hold your nose and do it. If you're trying to be more strategic, maybe those trend following indicators can help you, I don't know, some percentage of the time, but you're going to have to know, you're going to have to hold your nose, because you're going to realize that sooner or later that trend following indicator is not going to catch the move that you were most concerned with over time. So again, I would never go all in one direction saying I need to be fully protected or I have no protection. I'd always want to make sure I had some level of protection on, and just scale your protection as opposed to making it more binary.
So those indicators you mentioned, trend following, seems like you like technical indicators over fundamental data. Do you use both, either, or just technical analysis?
We use everything. So we look at the technical indicators, the options market, the fundamentals. We do some factor analysis, and then we worry about how much exposure does the client actually have at the end of the day. So that's kind of our method to our madness, is using what we call toffee, and utilizing those 5 methods of figuring out how much protection, when, how, and where to put that protection in place.
Great. Let's talk about path dependency. This is a pretty tricky world to navigate, especially in options land, because you have different strike prices, different expiration dates. So how do you navigate path dependency in the portfolios you implement?
We're flowing in a river. Again, we're not smarter than the market. We just know to some extent whether we want to pay up for being with the market or trying to be a little bit more discerning in the price that we're willing to pay for following in the market. So it's hard to figure out necessarily, when or how much of an option to buy, but the more important thing is trying to just find the relative value of that option across the entire expiration. And if we can find a pocket where it's cheaper, again, quote unquote cheaper, again, we have to make adjustments for time and earnings and all sorts of other things along the way. We use that methodology to help us find those pockets of value, again, relative value, and that's where we'd be buyers. And if something, again, the opposite would also be true, where we would help us be sellers of the option as well.
So let's dive deeper into that in the world of actually selecting options. So what are some of the general principles for buying individual option contracts? So how do you know what's overpriced, what's underpriced, what's cheap, what's expensive? What are some of the metrics or tools you use?
Yeah, I'd just say the go-to move is the implied volatility of the option contract, and that implied volatility number comes after you determine what the strike price of an option is, how many days to expiration the option has, what the dividend is on the stock, what the implied interest rate is on the stock on the forward, and then solving for what does that option price. What does that option volatility mean in order to solve for the price you observe in the market? And then from there, you can see if one option is priced at, say, 20 vol and another is priced at 15 vol, maybe you sell the 20 vol and buy the 15 vol. But again, even there, you have to be careful and make sure that's more supply and demand driven than some kind of event driven type of event that's making that one option be 20 versus be 15. So you really have to pay attention to what those data points are, why those data points are there, because like I mentioned earlier in our conversation, there are a lot of smart people doing a lot of smart things with computers to try to figure out this optionality already. So it's a little bit more challenging to think you're going to be the one that has this ultimately perfect, keen insight into the options market versus all the other players out there.
In your view, how efficient is the options market? Do you find a lot of places where sometimes options are just crazy cheap, crazy expensive, and you can take advantage of those discrepancies, or is that really few and far between?
Few and far between. I think if there's any crazy mispricing, that's being eaten up by the market makers before they even touch my eyes.
Yeah, sounds about right. So having seen what you've seen working at Arin, why is it, or is it a bad idea for retail investors to implement strategies on their own?
On their own, again, one of the analogies we utilize at our office is, look, you're going to a casino to play poker, right? You can either hire a professional poker player to play your hand for you, or you can sit at the table with the professionals. We like plan A versus plan B. You may get lucky for, several hands, and that is a distinct possibility. There's no guarantee that you'll lose money immediately. But if you're a retail investor, you have to realize that people do this for a living and they eat what they kill. So it's not a relative value game that you would experience maybe with an asset management firm where I can trail my benchmark by, 200 basis points or beat my benchmark by 200 basis points, but the market's down 10%. An option market maker makes and keeps their lights on at their home and pays their groceries with the P&L that they generate. So it's a much different mentality as opposed to some of these other investment classes where retail investors have probably a better shot at success than they would in the options market.
I wanted to hear your thoughts about the availability of options markets to retail investors. It seems to me that, especially after COVID, a whole lot more retail investors jumped the gun and started trading options. Maybe not as a moral thing, like, hey, should we allow these people to trade? But have you seen any changes in the market with the introduction of retail investors just ramping up and trading options more now than they were, say, like 10 years ago?
Well, I think the whole options industry owes RoaringKitty a big thank you, because what that whole GameStop AMC scenario did, that really pushed investors to push their advisors to become more aware of and engaged with the options market than they had ever been. So that's really been beneficial to the options market, because now you're getting more players, more points of view coming into the marketplace. So whether you're directional, whether you're betting on upside, a downside, whether you're hedging, whatever the case may be, more people have gotten more familiar and more, lenient towards the use of options than we've ever seen in the past. And of course, the options exchanges have morphed their offerings as well. So now we have daily options and things along those lines that really help keep the options volume at very competitive levels with the cash market. Again, it's not as competitive yet, but they're trying. So we have to give them credit for that. And to the extent that we're seeing more people come into the options market, again, that only helps with the depth of the market. And then we have more points of view on the market, which hopefully can take away some of these larger shifts in the amount of optionality that people were kind of used to in the past, where people could really lean a market in one direction against a retail investor, and the retail investor had no chance. Now, because there are more retail investors coming in, there's less of a chance of getting hurt as badly as there was maybe 10 or 20 years ago.
Wow. Yeah, interesting. That last piece you mentioned, never really thought about that. Have you, from your perspective, anecdotally, have you seen that interest peak in your firm over the past 5 years, where people are like, hey, options, I want to know more about this, or I want, or more interested in it now that this whole, GameStop saga, AMC thing happened?
Yeah, I probably should be sending RoaringKitty year-end bonuses or something for all the help they've provided to us in terms of kind of free marketing, because I mean, we've always been kind of the outsider looking into the wealth management space, and now I think more and more people are starting to embrace the idea of utilizing options in client portfolios, just because maybe they've heard that they worked in the past. I mean, the kind of the famous story would be of Mark Cuban utilized a collar around his Yahoo stock and saved him. He, obviously did pretty well since that trade, but those types of anecdotes, they were there, but they weren't as well embraced. And I think now with the RoaringKitty idea, and people just had the time to pay attention to it. Whereas in the past, we were running around, chauffeuring your kids from soccer to ballet to wherever you were going. You were stuck at home. Well, what can I do? I'll pay attention to this finance stuff. So Bitcoin was still a little bit on the fringe, but it did. Again, Bitcoin, I think, owes a big thank you to RoaringKitty as much as the options market owes a big thank you to RoaringKitty.
So let's switch to a quick question on the technical aspect of options, or the structural, I would say, zero DTE options. There's been some criticism over them, hidden risks that have been talked about. Do you believe that zero DTE options, and for viewers, this is 0 day to expiration options, so you buy an option and it expires that same day. Do you think they pose a structural threat to the industry?
Not at this time. I think it's more anecdotal. And why would you restrict someone from the way they want to invest their assets? If you think there's value in a zero DTE option, I mean, you want to bet on what the Fed's going to say at 2:00 on any given Wednesday. You want to be concerned about what the CPI print's going to be at 8:30 on any given Thursday. Have at it. But I don't think it's not the tail that's wagging the dog, anywhere to the imagination at this time.
So last question here. What would be one general piece of advice you would give to investors, especially young investors navigating through the often confusing world of finance?
Take your time and just be more mindful that the market doesn't offer anything for free. Kind of one of the examples I like to offer out to people, if there was that much money to be made, Goldman Sachs would own all of it. So be careful out there. There are a lot of people not in your corner. So if you are going to look for some assistance along the way, if you're not going to be a do-it-yourselfer, make sure the person is a fiduciary, because you definitely want someone on your team out there going against this marketplace. Because as I pointed out before, the marketplace is not going to be nice to everyone every single day.
If someone watching this wants to get in contact with Arin or Joe, where should they go?
They should go to arinllc.com. That's our website. On there would be some background information about options. So there is some information about how the options market are priced and some of the dynamics that would be impactful for the options market, and also, of course, our contact information.
I want to thank you, Joe, for taking the time, accepting this offer, and just taking the time to chat with me. If you want more content like this, educational content, you can go to alphaarchitect.com/subscribe. There you can subscribe to the blog. And I want to thank you for watching. We'll see you next time.
Thank you.